So good evening, everyone at CAGr, the Collective Analyst Group. And yet again, we have another expert person in the field of uh, energy right now as we speak today. And Nav is here. So Navneeraj heads the strategy and research function at Climate Control Digital. And he sits right across me in the office. So I know a lot of things that he does, and he knows a lot of things that we do. And generally, when we go out to grab a coffee or a glass of water, uh, we talk global energy. And that's how we met each other and realized of what Navneeraj's depth is in terms of energy and policy framework around energy and things like that. So Climate Connect Digital is a subsidiary of Renew Power. And it's a they build digital AI, ML, artificial intelligence, and machine learning solutions for ONMs, which I will leave now to throw light on, and basically focusing towards renewable energy. And when you might call it a battle between Nav and Emmanuel, but when we'll get into it, you will see that I am a very anti-renewable energy guy. I'm more inclined towards other alternate sources of energy that we will get to. But yes, and now is an expert at renewable energy and energy policy itself. Yeah. So prior to joining Climate Connect Digital, now was an analyst with EY, Ernst& Young in the Tax and Economic Policy Group. He's also worked between 2015 and 18 with the Chief Economic Advisor's Office with Government of India. He's contributed in writing multiple economic surveys, and he has, trust me when I tell you, he has deep down knowledge and analytical ability to understand numbers and to crunch them into decision making and to help companies take decisions or to help his clients take decisions. He has masters in economics from DSE, and he's an electrical engineer from PEC, Chandigarh. So thank you so much for sharing your time with us, Nav, and thank you so much for being here. So we want to start it from the base and then take it to whatever infinite level is possible in next 90 minutes. So and of course, I would be the one asking you questions, and we will have a lot of audience also who will be putting their questions on the chat box, and we have some questions that they've already shared with us. So my first question to you is, if I am new to economics, and if I'm new to understanding the world of business, or even if I have spent a couple of years in the industry, and I just want to understand of why suddenly energy is so important, because I have probably not been around during the last energy crisis or during other things. What would you say to a newbie or to somebody who does not understand importance of energy, because we take energy for granted, to be very frank. I can always switch, and I expect the light to come on. I can always press my AC remote and I can expect it to turn on and things like that. So I think we've taken energy for granted for way too long. Like Europe has taken heating gas for granted for multiple years now, and this year they're going to face problems. So if you want to talk about energy, what is it that you would want to reflect on? What's your view of energy, and why should we talk about it today?
Uh, sure, Emmanuel. First of all, thanks for having me here, and thanks for the introduction, Emmanuel, as well. And yeah, kind of a very broad question you have asked me in the beginning, but let me try to maybe do some justice to like how maybe we should think about energy. So what I would say is that in a way, it's by design that energy is all pervasive, and at the same time, you need to take it as granted. And that's one of the key business value proposition like right now in terms of how you should think about, say, energy going forward as well. And economics, we call these kind of technologies as general purpose technologies. And the idea is that they should be like the number of use cases for such things, you should not be able to like write on a piece of paper. But if you start doing it, you can't do it because people can think of a new use which you hadn't thought of and you hadn't put it. And just to give an example where I think maybe many people on the call will relate to it, same thing is happening with maybe AI machine learning right now. That people are thinking of it as a general purpose technology, where the number of use cases of it, no one knows now, even no one knows it. But at the same time, it's not all pervasive, and it's not like embedded in our life as much as, like, say, the technology firms are working on. But once it happens, the future may look like maybe what it looks like in Star Trek, that everything is happening seamlessly, and therefore you don't see all the under the hood things happening. So same thing, somewhere energy has traveled that journey maybe for last 10,000 years, and maybe electricity has done the same thing over last 300 years. So therefore, it's like we are standing on the shoulders of giants who have worked very, very hard to do all these things. But at the same time, maybe why energy is important and why like we all need to think about it is that I think it's one of the tightest correlation in terms of per capita GDP and per capita energy consumption. So in a way, the economic development or economic activity levels of a country are almost determined by how much energy they consume, especially on the per capita basis. And therefore, that it has become so important again is that because now of this climate change sector, which at least I believe it to be true, what needs to happen is that we need to think about all these things seriously, where we can maintain the economic activity at the level which, like, say, developed countries are, and maybe the developing countries catch up. And at the same time, what happens is that whatever energy sources we are using, they don't produce CO2 or greenhouse gases. And therefore, it has suddenly caught up, and whatever high energy prices we are seeing, and again, I can explain maybe going to level 2, level 3 details a little later, and therefore it has become important. And maybe the last point on why energy prices being high and all, again, as I mentioned, that it's so tight a correlation in terms of with the GDP. So what happens there is that I'm sure, like, many of you are belonging to invest world, and you have heard of this person's name, Hyman Minsky, who used to talk about credit bubbles, that good time lead to a creation of bubbles and then they burst. So something similar happens on the energy side as well, where there are cycles, and like over exuberance is there in investment terms, which leads to lower prices, and then people stop investing, and then what happens is that suddenly you realize that there are high prices, and because it's a slow moving sector, because capex takes a lot of time, there is a lot of shelf life in terms of you set up projects and all, so you can't do much in the short run. If prices go high, then nothing much can be done in the short run, and therefore you need to, like, wait for 1 year, 2 years before the energy prices go back down again. So therefore it's a cyclical thing, and again, maybe you have seen 2 or 3 of such cycles, then you believe that, at least extrapolate and say that, oh, this is a cyclical industry. So that's maybe like maybe my initial remark on these things.
Great. So guys, what Navneeraj is trying to say is that is exactly what we started the conversation is energy is always taken for granted, mostly by larger audience, and you will have to live a little longer to understand that it comes with cycles and a lot of uncertainties, and I think a lot of capital and resources and a lot of companies and human resources allocated just to make sure energy reaches our doorstep. So to begin today's conversation and to clarify it to everybody who is joining in as well, we're going to stay very focused and we're going to understand energy. And then we're going to relate to how energy impacts energy as a sector for investors. And then all the other sectors as well. So what has energy as a sector to do with automobile, let's say, as a sector, or what has energy to do with the asset cycle of a bank, and the lending patterns of a bank or the credit cycle of an economy and things like that. So we'll get into multiple layers of those conversations, and then we will try to figure out of how this particular element is governing or defining different other aspects of the economy. To begin with, I would like to ask now the categorization of where do we put energy as an asset class. So, for example, if we want to say commodities, and we say commodities can be broken into precious commodities and non-precious commodities, and thanks to this crisis, we've crafted a new basket where we're saying precious commodities, non-precious commodities, and energy commodities. For example, crude, gas, these cannot be compared to other commodities like wheat, soybean, or gold for that matter, or silver for that matter. You can live without gold and silver, but you might not survive in a European winter without natural gas, or you might not be able to generate electricity in India without importing coal from outside. So, how exactly would you categorize? I know you're in alternate energy, I know you're in green energy, but we will not have to forget the fact that the world is still dependent on fossil. The world is still dependent on commoditized energy, raw material, and how do you want to project that, and how do you want to make a sense of that to someone like me?
Sure. So maybe what I will do is I will start with something. Maybe I haven't understood the question maybe 100%, but let's start with something and then see whether I'm going in the right direction. See, the answer to your question lies in the first question you asked me, that if something needs to be all pervasive, then it needs to be commoditized. And if it needs to be commoditized, then like many people should be able to do it. And therefore, in terms of production of it, and it should not be very, very difficult. And therefore, it's almost like and again, the sector utilities, I know that it is one of the classification in asset classes in terms of, say, at least equity securities or even on the debt side. So what happens is, therefore, energy will right away like fit into that, and therefore no extra returns. And there is a reason behind it. That because energy is so important for people's day-to-day life, so all the governments keep a heavy check on them. So what happens is that you can't make super normal profits into these industries. So that's by, in a way, almost the history of last maybe 200 years, that anyone who has tried to do such things has not been able to sustain it for too long. And again, like maybe oil countries like Saudi Arabia and OPEC have been able to do it to some extent, but that's on the cost side because the cost is so low for them. So therefore, utilities is the asset class, and the reason is very, very simple, that many people can do it, very, very capital intensive. So almost like back or like 80-20% is the debt to equity ratio for most of the projects. So whatever is the cost of the debt, that's what you make in all these things. And on the clean energy side, same is true, because if clean energy has to replace this fossil fuel energy, even if the technology is new, the replacement will only be done in two cases. One, it's as cheap as what it is replacing, or someone else has to subsidize. And therefore, that's the route which European countries took. And now US is taking with IRA. But essentially, as an asset class, most of the energy companies will either come into trading or into utilities bucket.
That answer also leads to another question that we have under the sleeve. And that is, if there is no obnoxious profitability in the sector, and if we're looking at not just trading of commodities, not just buying coal from Indonesia and selling it to a thermal power plant in India, but if you're talking about being the thermal power plant, or if you're talking about transmission of energy, or if you're talking about being the supplier of natural gas and things like that, I cannot make obnoxious profits as an entity, as an organization. And hence, because of that underlying understanding, we've always been vocal and been saying that energy is not a sector for retail investor to participate in, or energy is not a sector for you and I as individual investors to participate in. It's a multi-decade capital exposure. It's a multi-decade play. And I think only sovereign funds, or only the governments, or only larger entities with a longer play should contribute to this, and with alternate reasons to be investing in it, and not a primary goal of capitalizing money or wealth maximization and things like that. So, what's your take on it? Because a lot of investors recently have been excited by the Adani play, the Tata Power play, the play of IEX, and of course, you and I both know that you've been very closely working on the IEX project when it came up and things like that. So, what exactly do you think, is the reason why investors are excited about the sector now, and the basic underlying understanding that you should not allocate individual capital to energy?
Yeah. So maybe one differentiation I will immediately make is that IEX is a completely different play than
Different.
energy, because it's a platform play. It's almost a SaaS model. And again, exchanges across the world enjoy those multiples, that their revenue multiples are like 10, 15x, 20x even on that side. And again, if you're profitable, you can be like EBITDA multiple can be like even 50 or 60 even. That's not unheard of. But on the other side, as Emmanuel mentioned, that again, I will just maybe put whatever like we discussed in a different frame. So if one constant I have heard, like as maybe whenever I studied financial economics, maybe it was a long time back, that the risk-adjusted returns are constant across asset classes. So that's the corollary on which many things work. And somewhere the risk preference of investors drives the investments which they do in different asset classes. There are people who will put money in FD. There are people who will put money in government bonds, or there are people who will only do bonds and very little equity. And then there are on the equity side that you can do whatever you do. So that's one horizon. And the other horizon is what is your term structure in a way, how long you want it to be, like how patient you can be. And I would say somewhere utilities in general and energy in particular, what it attracts is people like pension funds, sovereign wealth funds, who know that they can wait for 10 years, 20 years, 50 years, and whatever the risk-adjusted return after that they get, therefore utility sector and especially energy sector is useful. So that's the way most of the time it gets matched. That's the way the money comes in on both the equity side and debt side, and on the other side these projects get financed. Retail participation most of the time is very, very short term, I would say, because it's only the short term price spikes what we are seeing currently, where you can make these abnormal profits maybe for 6 months, 1 year. But we know, as I have been saying, and again, I have worked with the regulator in India. In fact, there is a staff paper right now at CERC website where they are saying that they will change the pricing methodology. They have already put a price cap of 12 rupees, where gas generators in India are saying that I can't supply 12 rupees per unit electricity to you. So regulators immediately jump in and they kill that opportunity. So as an investor, if you want to have this day trader kind of, or maybe 6 months horizon, then you can do it. But as a wealth maximizer, I have rarely seen people doing this kind of trades for simple reason that in the long run, the IRRs come down to either low double digits, 10%, 11%. In dollar terms, it will be 8, 9%. Even in India, renewable energy sector, the projects, even if Adani is doing, anyone is doing, the IRR for those projects will be 11, 12%. Whatever the gains we are seeing, most of them are leverage play. The equity amount is so less, the number of shares are so less for Adani Green that people are going and buying for them. So that would be my answer, that most of the time, this is the reason why it's not a great bet for retail investors. The regulatory risk, policy risk is very, very high. And maybe case in point, like everyone says that maybe India is a socialistic country and maybe US is one of the best capitalistic countries in the world, or even Western European countries, developed countries are. But I don't know whether it was the news yesterday only and many of you saw it or not. Biden administration is thinking of putting a supernormal profit tax on the energy companies in USA. So that's how it works. And all these things come falling down very, very quickly. And therefore, retail investors if you don't have a horizon of less than 1 year, I would say it's a dangerous strategy to play with.
Yeah. So thank you now for clearly putting it out bluntly that if you are a 1+ year investor, you should actually not be focused towards energy. Now, to understand that, we will also have to understand. So, for example, like you corrected me and said, you cannot put Adani and IEX in the same basket, or you cannot put Tata Power and IEX in the same basket. How about we talk about the energy value chain, right? And we talk about how probably a coal mine or a natural gas well ends up being the electricity at my house, or how does a natural gas well end up being the cooking gas at my house, and who are these mega invisible players that are involved in this, and how does the transition or the relay actually happen? Because unless I understand who's playing what game in this value chain, I don't know which business to be in, to marry, and which business to avoid, right? So how about we discuss the energy value chain once for everybody?
Sure. And again, it's fairly simple. It's not very complicated sector that way. What you will find is, indirectly at least, government is the big dog in the sector. Government keeps intervening. Whatever way they find, they keep intervening. So it's not like digital companies, tech companies you look at. Even there it has started. And again, the common theme is anything starts becoming a general purpose technology. Internet is one where maybe the evolution has happened. Government start coming in and saying that, oh, I want to intervene because it involves the welfare of so many people. So in energy, the big dog is governments across the world. Therefore, just to case in point, and again, if you look at India, Coal India Limited controls maybe 95%, 96% of coal production, which happens in India, or 80% now because there are private mines, at least on the metal side. So NTPC still remains one of the largest electricity producers in India. Aramco, one of the largest, again, they got listed, I think, 2 years back, but still 90%, 95% controlled by government of Saudi Arabia. Russia, no one knows what is owned by whom and what is there. There are these old companies, Shell, BP, Chevron, again, like one or two names I am forgetting. So these are the guys who are doing all these things. So one, on the exploration side, where they are doing the discovery in terms of where the oil well is. And again, it's a very, very risky activity. In terms of, again, I have been involved in this somewhere in my like pre around this. It's as good as astrology. There are geologists who like maybe are as superstitious as like maybe person believing in luck completely. And it's again, there is a science to it, but it's more of an art. And you keep digging the earth in hope that you discover something. Once you discover something, then you say, okay, maybe adjacent to it as well, something will be there. And sometimes, like again, you get a gold rush and you strike something. And again, the counterpoint to that, Bombay High. People have not been able to discover anything around it, and everyone has burned money on that. Reliance has burnt money on that. PP in tie-up with Reliance has burnt money on that. ONGC has burnt money on that, and India hasn't found anything in Bombay High. And Bombay High is the only Bombay High there. Nothing else is coming. So coming back to this, the big players on the E&P side, because it's a very, very risky activity. It's a capital intensive, but at the same time, very, very risky. So you don't know whether you strike gold or not. And whatever expertise is 100-year-old. So all these companies like I mentioned, BP, Shell, Aramco, all even ONGC in India. So all these guys are on the upstream. In the coal, CIL I mentioned. And again, there is BHP Billiton in Australia. And again, one thing which you need to first understand, what is the geography? Where is which mineral resource available? So coal is available, say, in India, Indonesia, South Africa, Australia, a little bit in US, then there are other countries. Russia is also there, other countries are there. And each country will have one or two players only at maximum. not more than that. It gets monopolized on the upstream side. Then logistics, most of these guys do their own logistics, because most of the time what happens is that there is nothing. Wherever there is mine, there is nothing around it, and you need to haul all these ores for 200 kilometers, 300 kilometers to the seashore. Then you build your own railways or whatever. Most of the time it's railways only, because that's the cheapest way to do that. And again, once that happens, shipping is fairly standardized, and that's a completely different industry, and that comes in. On the electricity, again, there are multiple players, but I would say that 70-80% of them in each geography, because each country needs to have their own, say, electricity generator. I would say it's an oligopolistic industry where there will be 4 or 5 guys who are controlling most of the electricity supply in terms of generation. Only thing with renewable, it has changed, but that's a unique thing, commoditization in terms of how you set up things as well, which I can discuss later. Then comes transmission of electricity, which is like, again, this is a favorite example if you have studied economics, that if people have to give a definition of a natural monopoly, they give this definition that as your scale keeps on increasing and size keeps on increasing, your costs keep on falling. So the two biggest examples there are railways, and second is transmission sector. And therefore what happens is most of the places, they are monopolies, and most of the time these monopolies are run by or owned by the government. And in India, this case is power grid. Then we come to maybe the distribution or the retailing side of it. And there again, if you look at it, most of the distributors, they also have a kind of an oligopolistic structure where 4 or 5 guys are controlling most of the supply. India, it's a monopoly. We have government-owned monopolies on electricity, on even oil and gas. Like gas has changed a little bit because of these city gas distribution licenses, which have been done over the last 10-12 years. But most of the oil supply is controlled by IOCL, BPCL, HPCL. And that's the same structure across the world. If you go to Europe, you will have EDF, ENGIE, these kind of players who are controlling most of these things. So fairly oligopolistic or monopolistic structure, and big guys control all these things. Only set of interesting people which I haven't talked about, and who are like maybe very, very interesting, and they have their own game to play here. Those are traders. Ultimately, what needs to happen is that there needs to be some kind of matchmaking happening between buyers and sellers on the wholesale side. Say, again, this is in news very, very recently because of Russian oil. That, or say someone has discovered some oil in Nigeria, and now that Nigerian guy has to pump out that oil and then find a buyer for that oil. And the Nigerian guy maybe doesn't understand this market completely. So there are these energy traders. And again, there are 4 of them. Governor is one. Okay, sorry, I'm forgetting the names. 2 or 3 names more are there. I will just tell you, it will come back to me in 1 or 2 minutes. But again, 4 traders who control most of the energy supply in the world, and they play the matchmaker. And all of them are involved in bribery scandals or all kind of problems which you see with the energy sector or corruption. And all of them are private. None of them are listed companies, because they can't do all these things under the public disclosure kind of rules which are there for publicly listed companies. So in a nutshell, that's the summary of how value chain looks like.
Great. So for everybody who is currently a part of this call, what now this clarified is actually available on this book, and it's in one of the best books that I've ever read in my life. It's called The World for Sale: Money, Power, and the Traders Who Barter the Earth's Resources. I have a hardcover at my office, and I refer to this book as in when I can. And this covers a lot of traders that now was covering, like Mark Rich, 1980s, 1990s, and Solomon's, and all those other different trading giants who sell and buy oil and coal and whatnot between economies and between producers and requirers. And it's one of the most insightful books that I've ever read in my life. So I would request anybody who's interested in the sector to pick it up and to read it before we start investing or make assumptions about the industry. And also, like Nav rightly said, most of these companies are privately held, because when if they tried to go public, I don't know the name of one of these businesses that tried to go public, and it's mentioned in the book, and then there was a Senate call, and all everybody was behind them, all the watchdogs were behind them, and things like that. So uh, going ahead and to what now just summarized, uh, now, Neeraj, how about we spend a couple of minutes and discuss IEX, because that's also a very interesting business. A lot of people got lured into the rally of the price going to the top and then coming back down, and now they have no clue of what the business does, and whether they should be holding on to the business and things. I know we're not here to tell what the price of the business is going to be in future or what the stock price is going to be, but what does the business look like? What does it do? What is the significance of it? And is this business different? And can retail investors participate in businesses like this?
Okay, so I will like, try to maybe give you a little bit of history or that how IEX got created, but at the same time, it's a fairly standard business. Uh, uh, it's a counterpart to say what happens on NSE or any equity exchange that you need to say buy and sell securities, and therefore you need a marketplace. And of course, I think everyone understands here OTC versus exchange uh, kind of classification. When do you go to an OTC market? When do you go to a exchange market? Idea is that OTC is customized for you, whereas exchange is fairly standard contract. You know T plus one or T plus two clearing and settlement schedule. You need to pay upfront money, margining. All those things are very fairly standardized. Everything is dematerialized, and therefore you can trade. So one beauty of electricity, other than the transportation and the physical aspects of it, is that it's a completely fungible product. Uh, uh, at the end of the day, it's a flow of electrons. All electrons are the same. So there is no differentiation in terms of this is a green electron or it's a wind electron or solar electron or coal electron. So it's very, very easy to trade electricity as a security almost or as a commodity. And what used to happen was that there was no standardized market for it. And somewhere what happened was that the developed countries, say the US, which is a completely different kind of model, but Europe pioneered this idea of setting up of exchanges. And these are like almost like 20, 30 years old in Europe at least. And therefore in 2006, India also picked up this idea that we are doing a lot of this generation capacity setup. Why don't we set up a day ahead market where, because it's very, very difficult to do matchmaking closer to day, because electricity has this problem that it can't be stored at large capacities. So what needs to happen is that you need to consume it immediately, or you need to produce it immediately and then it gets consumed. So day ahead market is an ideal platform to do these things, where matchmaking or a matching of people, if you do it for like 5 days, it's an opportunity lost in terms of trading or whatever you could have produced and therefore traded. So that's how like IEX came in, that in 2008, I think they got set up. CRC gave them the approval, and they have a fairly standard business model. It's not rocket science. What they do is that whatever units of electricity which get traded, they take 2 paisa from the buyer on the transaction, 2 paisa from the seller. And it's completely that way a software as a service kind of a model, where it's a platform, marketplace, people come in, they put their bids between 12 a.m. to 12 p.m. every day, and they get matched. Whatever the volume is, you multiply it by 4 paisa. That's the cash flow IEX generates on a daily basis. And in terms of cost, biggest cost is human capital and whatever they do to maintain software. So the margins were looking very, very great, because what was happening was that there was no new capacity addition happening in India, because the distribution companies were not uh, like ready to sign long-term power purchase agreements, these 25-year contracts which they signed. And whatever volumes were increasing in Indian electricity markets, they were increasing on the exchanges. So if I'm not wrong, in 2008, the share was 0%, correct? Now, right now, share of IEX, or because that's the dominant exchange, is 5% of total uh, electricity generation in India, which is 1600 billion units almost. 1300 is in the like the market side, 300 is on the captive. So 1300 billion units, 5% of it is IEX. And government has been trying very, very hard to increase that number to 20-25% in next 5 years. And somewhere the belief is that this 4 paisa which they are getting on each transaction, that will continue. This quantum is increasing, and most of it is a cash flow. And like there is no, whatever the fixed cost is, it is. So all of it will go to the bottom line, and therefore the stock ran. But that's not how things happen. And in a way, that's what I have been hinting at, is that as soon as this starts happening and these profits start going up, what will happen is people have already been questioning for last 5 years, why does IEX get 2 paisa each on the transaction on both sides? Why can't it be 1 paisa? Why can't it be 0 paisa? Why can't it only charge the seller and nothing on the buyer? Because that's what happens on Uber. That's what happens on, that's what Google does. That's what Microsoft does. So why can't all these things happen here? That's one. And second is, again, which is inherent in the answer which I gave, IEX is a monopoly right now for all practical purposes. They have 99% or 99.8% share in this market. So that's why that's what I think drove this frenzy. But at the same time, I would say that if someone has this 10-year horizon or a 5-year horizon, all these things will get rectified by the government slowly. Governments are very, very slow in doing all these things, but their hammer, whenever it hits you badly. So I can tell you that these are all the things which are on the cards, not in terms of that I know something, but these are the kind of things which governments do when they see that someone is making supernormal profit.
Great. So though IEX is not in the same basket of businesses that we're discussing, but even if IEX goes out and makes supernormal profits, right now, as we know, IEX has a return on equity of a 3-year average return on equity of 46% and an ROE of 48-50%. What now is trying to focus us to is, if it remains abnormal or if it remains supernormal, the government will have to intervene, or the players will have to intervene and ask them to reduce their profit per trade or their revenue per trade. And then that's not a good situation that we want to be in as a shareholder, right? So now that we've cleared the value chain and that we've discussed about various components of the value chain, I think what we're establishing with every point that we're going forward is retail individual capital should not be allocated to the energy sector overall, right? Unless you want to make a quick buck, or unless you want to make a quick trade on based some information that you have from somewhere. If you're an investor and if you're looking for wealth maximization or multiplying your portfolio, you should not be looking at energy as a sector. It's not your sector to contribute or play in. On the other side of it, now can we, like you said, why there are buyers and there are sellers in an ecosystem, and like you said, most of the players in the value chain are oligopolistic players, where the only buyer or the sole buyer is government most of the times, and then of course it redistributes to whoever it wants to redistribute to, at whatever price government feels it wants to redistribute to. And of course there is an element of democracy and politics and the vote bank, where you see subsidiaries coming in, especially when you're talking about electricity or we're talking about other alternate energy. We saw the central government take out a portion of its revenue from oil because the prices were at a lifetime high. So what do you think on the governance side of it? Or how do you what does your gut say on the governance side of it? is it an investor friendly ecosystem, or will it always be a public friendly ecosystem? We know we're establishing a fact one after the other that the business in itself is very regulated and it will always remain public centric. But because of how we are a democracy and not a monarchy, and thank god we're not, but because we're not a one man rule or a one family rule kind of a system, will governance also impact us being investors in this sector?
Okay. Before I answer, just to like what I had forgotten, I remembered their names. So the big four here are Trafigura, Dunbar, Vitol, and so these are the guys, and Glencore. These are the four guys who control most of the commodity tradings on the energy side, at least. And they are massive, and at the same time, like they have evolved over like 30 years. Now coming back
And
to this.
and
Yeah.
all their deals are over the counter. They are not an
Yes.
exchange. There is no transparency. There is no fair pricing. And I'm assuming there is no paperwork most of the times. It's just via the. It's like a marketplace. You go to them, you pay the price, and you get whatever you want. And you can be an economy, you can be a government, or you can be an organization, or you can be a whatever you are. You just pay them and you take whatever you want. Is that how these four work, or are they
Yes.
also just serving the governments across the board?
So, so they are very shrewd and smart set of people. Goes without saying. But at the same time, it's not a Wall Street kind of job where you go to New York or say London office and like you're talking to very nice people in your suits. You travel to the most dangerous places on earth to do all these trades. But at the same time, they have their own way of making money, and they have been in big trouble in the last 1 year, and especially after whatever has happened in Russia, because the incentives are such that a trader individually sitting there, he doesn't care about morals and ethics. If he sees that there is a Russian oil which is available for $40 and the price for that oil in the demand side is $100, $120, he or she will try to find a way to pump it to the other side. so again, and a lot of things happen. And if you want to read this same person, which Emmanuel shared, Javier Blas, he writes for Bloomberg, and I think he has written many columns on these things in the last 6 months. And nothing else, you can check his Twitter handle where he has shared many of these stories, how these guys have done it in the last 6 months. So going back to what the original question Emmanuel had, see two sectors, and that's why I have worked in CRC, I have worked in Ministry of Finance, two sectors where governments are obsessed about intervention. And both these sectors are commodities, and you can see why we are in a mess. One is energy side, the other is agri. They can't leave them alone. And unfortunately, or fortunately, one of us becomes a politician, even maybe a small politician, we also will be obsessed about all these things, especially in a developing country. Maybe even for a person like me, who is almost now 40, this is the first experience how European countries are handling, or developed countries are handling energy or high food prices crisis. And I can tell you they are behaving the same way. So it's almost I now take it as a corollary that these two sectors can't be free from policy and regulatory risk. And they are completely driven by this thing that prices can't be high for too long, because it has a direct bearing on who wins the election. One test will be what is going to happen in US in next 3-4 days, because there are Senate and Congress elections. Prices have been high, and Biden administration, whatever reason, like people thought that they should win, but again, purely because of high energy prices and high inflation, people are saying that their chances get dented. And same is true for say country like India or developing countries. And case in point, I don't know how many people here know that the Arab Spring crisis started because of commodity prices being high at that time. Both the oil prices were high in 2014, and the wheat prices were very, very high. And somewhere all the social unrest, all these things somewhere start, and some other excuse comes in for that, that someone slapped someone. It starts from that, and you have Arab Spring in Tunisia. But the real reason is that people are really, really angry. So politicians will never ever. I can take bet with anyone. Even in 50 years, will leave this sector away. Never.
Great. So agri-tech and energy is a sector that probably you should stay away from because regulations are inversely proportional to rewards as an investor.
Farmer protest, my friend. It happened in front of our eyes.
Yes.
And government didn't dug down their heels for 1 year, but they couldn't take the pressure. So it's
Absolutely.
very, very difficult, very, very difficult. And again, if we are in their shoes, we will do the same.
Absolutely. And like we say, you give someone power and then they would have to make mistakes because not everything can be right or not everything can be done right. So shifting gears and moving towards the other side of the story, I know you're a green energy consultant and you're pro green energy, and I'll come to my reasons why I dislike solar or wind or whatever form of alternate energy that we're getting into. There is one form of alternate energy that I am obsessed about, and it happens to not exist as we speak today. We had a small chat about it in the office, and then you were also positive about it, but then you were like, the world is not yet ready for that source. We'll come to it at last. What do you think about India? As of today, we are the world's most populous economy. We will shortly be. We're still at a $2,000 per capita income, not trying to go towards $4,000, which we're saying is the tipping point where India will no longer be a poor man's country, and we will have some decency for life and some decency in the way everybody lives and stays in India. Uh, we cannot copy what the industrial era or the first industrial revolution happened in Europe, and we cannot copy their model. Neither can we copy the US model, right? Or we cannot go ahead and go through the blueprint of China, of how China exploited resources and made its manufacturing facilities one of the world's best. If we do that, we're gonna need more energy than what it is, right? We would need more coal than it is. We will need more crude than it is. So how exactly do we make sure that our dependence on fossil, and who exactly are the key players who are making sure that we are dependent on fossil, and they want to hoard and manage fossil in a way where our growth is probably just dependent on how we import and manage it.
Okay. So let me answer it in a little different way. And again, it's not about being pro something or anti something. It's more about how should you think about all these risks. In a way, it's again, I don't know how many of you have seen climate change modeling, but it's essentially like a financial model only, where you need to have a discount factor. And if you have seen all these models, people fight like cats and dogs on what should be the discount factor for bringing back the cost of climate change to the present, and the benefits as well in terms of whatever the new technologies get created. So it's an important economic decision. And somewhere, if again, as I said in the beginning, the corollary is, or the axiom is, sorry, not corollary, but axiom is that climate change is real, then you need to do something about it. And if CO2 emissions lead to increase in temperatures, then you need to do something about CO2 emissions. And I don't know whether you know of this guy, Mark Anderson, who is I think a venture capitalist who created Mozilla Firefox, and he wrote a Wall Street Journal article, I think in 2011, if I'm not wrong, software is eating the world, where his thesis was that software is going to be everywhere, this general purpose technology, which in a way I am obsessed about. So it is going to be everywhere. And energy already has the same attribute. And the way I see this thing happening is that decarbonization is going to eat the world, in the sense that every one of us will have to think about it or are already thinking about it. So it is going to be everywhere. if renewable energy, somewhere wind and solar is going to do that, then people will go ahead and do that. No way that this momentum now it gets lost, or like it will gain and gain and gain only. And again, again, I think it's a Bill Gates quote only, that what you can do achieve in short term, you always overestimate, and what you can achieve in the long term, you always underestimate. So that's the power of compounding. And again, we are discussing here in a kind of an investor forum that compounding is a big force in all these things. You don't think about the multipliers. And at the end of the day, the only thing which can stop this force, which is now currently prevailing, can't be economic. It has to be physical laws. If the physics is against something, then only maybe you can say that it's not going to happen. Otherwise, the momentum is such that all the technologies, all the things which are possible will happen. And I don't know, because this news didn't reach India, but this Inflation Reduction Act, which like Biden administration has cleared, in a way is creating another general purpose technology, which is almost opposite of what we have been doing for the last 200 years, where what we have been doing is that we have been pumping out resources from the ground, say natural gas or oil. Now what we can do is, by making suitable modifications, finding suitable geolocation or geographies, what we can do is we pump in CO2, which is direct air capture, or CCUS, which we talk about. And they have given such a massive boost to this technology that if in 10 years, the way the things are scaling, that in itself will give us the option of like in a way cleaning our air from CO2, because we just set it up, and maybe we will have this CO2 pumping tools everywhere in our houses. We just put it there, and it will convert those CO2 into bricks. So that's the way I think we need to see it. That somewhere world has decided that we need to reduce the CO2, and whatever makes it possible will happen, and governments will at least put their actions behind them.
Great. So now what you're saying is the future looks bright, and I'm sure all of us are optimistic people. That is why we are investors, or that is why we are on this call. If we were so pessimistic about the future, we might not want to know what's coming around the corner. So what you're saying is future is bright, and it has to be dominated by alternate energy, or it has to be it needs to be non-fossil, right? So as an investor, or as a person who is taking shots on where the money is to be allocated, or as a person who wants to understand the ecosystem better, what do you think, is this going to impact, or this transition is going to have an impact on other sectors? Let's say closely associated sectors like auto. We have already seen Tesla being the most valued business in the auto space, and we've already seen those drastic changes happening. So apart from just auto and just EVs, which I am sure 60-40% of that is a fag, and probably 60-40% of the other pie is real and is really trying to solve a problem. What do you think it will be impact of this transition from fossil to alternate energy as a factor on other sectors?
So before I answer that, maybe 20-second, like in a way, clarification. So what is happening on climate change side is that the target is 1.5 degrees Celsius by 2100. If we do that, we don't see drastic changes in climate, because we don't know about feedback loops. So still unachievable.
This is the degree to which the global temperature has to rise. Or
yeah,
we can let...
if we stop at that, and the baseline is 1800. If you from 1800 year 1800, the temperature rise by 2100 is 1.5 degrees Celsius, then we are fine. Most likely, in probabilistic terms, 90% chance we are fine. But currently, whatever actions Paris deal he had announced, it takes us to 1.8 degrees. It doesn't take us to 1.5 degrees. There are scenarios which people say that 2 degrees also going to be fine. But the worst case, which again I don't know whether you saw this IEA report. So the news is mixed, that the worst case temperature has come down by 1 degree. Now we are not going to see 3.7, 3.6. Now we are going to see 2.7. But the best case which we want, 1.5, still not possible. So still we need to think about that. Again, stories mixed there. And again, COP27 is around the corner in another 10 days, 15 days. So we will need to see what happens there. But at the same time, the story is mixed. That the worst case, we are like shaving off on that, but we are not reaching on the best case. Now, coming back to answer your question, electric vehicles, again, I think everyone has identified that as an opportunity. I would say it's the same kind of sentiment where like future is here and it's unevenly distributed, as I think it's a William Gibson line. Europeans or Americans in a way have already realized, and what are those opportunities here in India? So one opportunity, and again, there is this McKinsey report incidentally, which has come today only. The way to identify, maybe let me just say that what is going to be the algorithm for identifying that is global trade linkages. Wherever there are global trade linkages, what is going to happen is that if Europeans want to do something or Americans want to do something, then Indians and Chinese have also to do it. Just to give you an example, there is a reason why Reliance Industries has chosen for 2035 as a net zero target, because their O2C business contributes, I think, even now, I think 50 to 60% of their revenue, and largely it's exports. Now, what is going to happen is that Europe wants to protect their industry in their whatever guys who are producing in Europe, and they are going to introduce this thing called carbon border adjustment mechanism, which says that any good coming from outside, if there is no carbon emission calculation and carbon pricing or carbon tax on that, then that commodity before entering into Europe will be taxed. And therefore, incidentally, it will get passed to the seller rather than the buyer, because the buyer will say, I can buy it from a European guy, or the South Korean guy will say that I can give you that steel, which say SAIL or Tata will not be able to give you because I have decarbonized or I have paid that tax. So that's the linkage, and therefore finance is playing an important role there. That anywhere where say European, American interests are there or exports need to happen, those industries will need to decarbonize faster. So I don't know, pharma comes to mind. On the other way side, commercial real estate, because it's controlled by entities like Blackstone or KKR, where private equity guys have to meet their net zero targets, and they are being forced to like do all these things. Therefore, they are pushing it on all the commercial real estate which they are buying. So you're seeing that most of the buildings these guys are buying in India are LEED Gold standard, LEED Platinum standard, correct? So in a way, what is happening is that whatever Europeans and Americans decide that they want this asset to look like that, people are producing those assets. The other example is data centers. If Microsoft, Google, and Facebook or Amazon have announced that they want to do net zero, then even in India, if they want to do data centers, they will do through decarbonization, and they will have renewable energy and all those things built into all these things. So EVs is one, buildings is another one. The another rising one, which is I think underestimated, but very quickly the situation will change, will be textiles, where because we are, again, Bangladesh and Pakistan are one of our competitors, and China is another one. But what is going to happen is that European fashion houses like Zara and all are working very, very hard on how to do decarbonization. The only difference is, it's almost like a primer, but if you don't know about scope 1, scope 2, scope 3 emissions, all these suppliers will come under scope 3. And it's a matter of, I would say, year only, 1 year, 2 years, that Zara, H&M, Marks and Spencer, Gap, all these guys start putting these restrictions on their suppliers, that where is your decarbonization net zero thing. But big investment opportunities are in the area of chemicals, EVs. You have seen steel will happen again. Tata and all these guys will start investing heavily because they are export markets. They're not supplying for India only.
Yeah. So also when we realized that we're going to be a $6 trillion economy, we also realized, I mean, of course, in let's say a decade or so, we also realized that most of it has to come through exports because we cannot consume the kind of commoditization that would happen when we become a $6 trillion economy on that scale. So what you're also suggesting is to focus on export oriented businesses, and maybe they are the first change makers, and they are the ones that will invite and implement change first and be better in terms of technology and efficiency as compared to other players who are just catering to the local ecosystem, right?
Exactly. That's the way it
Okay,
is happening, because somewhere everyone has realized that people who control the money, if you push them, then they will start doing all these things. And that's what you will hear in COP27 as well, by the way. Just wait and
great,
watch. All the banks, all the investors, they will say, oh, where is your net zero target?
great. And once we're discussing this now, there is a lot of buzz around carbon credits and exchange of carbon credits, and how carbon credits will be the new digital currency and things like that. And it is to a layman, exchange of air or exchange of something that does not exist, right? So we've come to understanding how cryptos work thanks to all the media attention and a price bubble, and now the burst. What do you think about carbon credits? And if you want to explain it to someone like a newbie, how will you explain carbon credits to them? And what level are we, or what turf are we talking about? Who are the players who are going to play in that zone, and what can we do about them?
So very interesting. And again, this is something which I didn't know much about. So I have also learned in last 6 months only. And when you have this kind of a market designer lens, because that's what I have been doing most of the time, that where how do you think about market structures and how do you design markets? So I have seen, and it remains fascinating what is happening on carbon credit side, because it has exactly the opposite problem to what say I have been saying till now in terms of standardization. That if something needs to be traded, you and again there is this very beautiful book, The Box, that when everyone started having these shipping containers, immediately it gave a boost to trade, because then people could quickly offload and unload the ship. And similarly, electricity, I said that it is a standardized commodity. Electron is an electron. Say securities, once dematerialized, only the company names are different, but they are standardized commodities. Carbon credits are completely opposite of that. And maybe the easiest way to explain that is that someone else reduces carbon emissions on else behalf of someone else. Essentially, what you are saying is that say I put a target on myself that I will reduce my current emissions are 100, I will reduce them by 5, and I will take them to 95 next year. And rather than doing it myself, I continue to emit 100. But say Emmanuel somewhere did something on the energy efficiency, and he reduces carbon emissions by 5 units. I go to Emmanuel and I say that please give me these whatever emissions you have reduced. You don't show them, and I will take it from you. And for per unit, I will pay you $5, $6, whatever. I continue to do 100, and Emmanuel maybe has reduced by 5. Now it has all the problems in terms of like what you say standardization would require. That there are all the different ways Emmanuel could have reduced it, and there are other people on the call. Maybe Emmanuel did it through renewable energy. Maybe Emmanuel planted a tree. Maybe Emmanuel, rather than planting a tree, only clean the forest so there will not be a fire there. And so whatever like fire would have led to increase in the amount of CO2, that wouldn't have happened. Maybe Emmanuel just bought an electric vehicle, and that led to a reduction in CO2 emission. So all these technologies are there, all the different geographies it's happening, and then all the different time periods it's happening. Someone did it in 2012, someone did it in 2015, someone is doing it in 2021. And then what you want to do is you want to standardize it to 1 ton of CO2. That's the reduction or increase, and that should be linked to some kind of price. And it's very, very difficult to do it when the geography is different, technologies are different, methodologies are different, years are different, and on top of that, the baselines will be different. Baseline being different means that if in India someone is doing this thing in 2011 or 2012 versus say someone is doing it in South Africa in 2014, then how do you compare these two numbers across India and South Africa? Because the energy mix in that country will be completely different. So all these challenges are there, and somewhere people are thinking very hard about all these things. Right now, the situation is so bad. Just to give you an example, maybe this will make it very clear. Right now, say, let's take the example of my parent company, and I think it's a public knowledge, so it's not very thing. Renew Power raises debt as green bonds, okay, where this money is coming from pension funds, sovereign wealth funds, who say that we have invested in projects which is leading to reduction in CO2, and they put this number in their impact reports every year. Okay, Renew Power itself shows that I am doing this. Okay, Renew Power also sells carbon offsets for those PN projects where someone else buys those carbon offsets and says that they have done it on my behalf. Government of India also shows that I have given subsidies to Renew Power, and therefore they set up a project in India, and that's leading to CO2 reduction, and it's included in my target. And of course, whosoever bought those offsets from Renew Power, they are also saying that I am reducing my CO2 emission. So now 1 unit of reduction of CO2, at least 3 or 4 entities are showing. And that goes to show that there is a problem of double counting, triple counting. And if this was happening in a financial accounting, people would have pulled apart their hair and said that this is a fraud, correct? So this is where carbon markets currently are. It's going to be a very long journey. I don't know whether it's possible as well or not, but at least these are the kind of problems you need to solve. Again, just to give another example, maybe you bought a carbon offset where someone had set up a forest, correct? Now that forest grew for 20 years, and you said that, I have reduced this much of CO2. But after 20 years, it caught fire, and everything was, all the CO2 was again in here. So we call it a permanent risk. So all these risks are there. How do you manage all these kind of things in carbon markets? This is where it is. And the way I explain, it's like, I don't know, I think the Dutch invented double entry bookkeeping in 1600s of it, correct? So it's that era in carbon accounting we are. And we need to travel this 500 year of journey and reach something very quickly, which is kosher, clear as happens in financial accounting. Again, it's very complex, and you can have multiple interpretations, but it's very early days. Yeah. Wild West completely.
Great. So I liked how you gave the example of magnifying the effort by one entity and then multiple entities taking credit of it. And maybe then it's not as great as it's been spoken about. But something is always better than doing nothing, and maybe that helps roll ball or it lower than what we're expecting the impact to be. Great. So while you're moving closer to the end of 90 minutes, guys, everybody who's on call, if you have any questions, please feel free to put them in the chat box, and we'll take them up if if time permits. Any questions regarding energy sector or any other sector that you think is impacted because of energy prices and other things, please feel free to put them in the chat box. Now, before we go to the questions, I had a question, and that is very simple. That we also have a couple of traders on the call and a couple of quick money rotators. We've generally seen that, and this is overall related to commodities. We've seen 2 commodity cycles in last 10 years, and it's not a great thing to see, to be very frank. Every commodity cycle comes with its own havoc on the normal economy. We've generally seen that commodity cycles, while the prices are going up of the base commodity, the stock prices of a particular company also follow. And when the commodity or when inflationary measures are brought into monetary policies and other measures, and when the sentiment also cools down, we've generally seen that then there is a plateau in how the commodity prices are and also the performance of the business. Why does increase in price impact? I know it impacts the balance sheet, it also impacts the EPS, it impacts all the other measures, but what is the need for a change in commodity price to be discounted in the business model, or what is the need in the change in the commodity price to say, okay, if crude price is going up, ONGC should have a better valuation? Why is it so? Apart from all the accounting factors, we're talking sentiments and behavior here. Why is it so?
See, I think it's fairly standard. Again, whosoever has done the numbers and they can see it, is because the cost is not changing commensurate. And therefore, say, because this is very, very famous example, the lowest cost in the world for oil production, I think, is $5 in Saudi Arabia or Kuwait. Kuwait is, I think, lowest, $4 or $3. And now what happens is that because there is marginal pricing, correct? The last demand unit, whichever is getting cleared, most of the guys pay that, correct? So what happens is that Saudi Arabia or say Kuwait, or say, I think for Russia's case, it's $18 or something. So if price is $40, they are going to make $22. Russia, Saudi Arabia is going to make $34, correct? And now if the price goes to $100, they're going to make $94 versus $82. Maybe there is some change in whatever this cost. And same is true about the companies as well, that most of these companies are going to do this. The argument for not intervening is a different argument. The argument there is that if the prices don't remain high, you won't see new entry happening. And therefore you are, in a way, this Hayekian argument that you are distorting with the price, then what will happen is that the new guy who is coming, he's not getting the right price signal. And you have seen that if you see enough of booms and bust cycles, that this is actually true, that this affects the investment, and people have done this research deeply. But essentially the point is that it directly goes into the bottom line. And one way to other way, funny way of seeing it is that all these Middle Eastern countries, if they were giving consultants the projects to see how they can bring down their liabilities in terms of pensions and everything. And in between, this Russia war happened, and everyone changed their TOR, terms of reference, and they said, how can I spend more? Tell me how can I spend more, and give me ideas around that. And the other reason there is, and especially with ONGC and everything, they will not want to invest in the short run because they know it's a short run thing. So they are just going to pass it on as dividend and all. This is the defense of, by the way, ExxonMobil CEO in US. Someone asked him that why shouldn't you be taxed? He said that I am paying $50 billion as dividend this year, and that's my way of giving back to the people. So you buy my stock. If you buy my stock, I will give you a dividend. So that's the reason, I think. But again, I am not a finance expert. I haven't seen these numbers. But theoretically speaking, most likely this will be the reason, that this goes directly to the bottom line. And they don't want to start kicking in the capex. They don't do that because they know it's tempting. And Great. Especially the other problem is there, by the way, you can't get to raise international debt. On coal projects, you can't raise international debt. On oil projects in India, only domestic financing will be available on the debt side. No one is going to touch you. So that's the other reason.
Great. So before Gagan has raised hands, so Gagan, just before we go to you, one last point that I forgot now. The entire process where RBI let the government buy crude from Russia or on a rupee exchange and not use dollar as a base because of how the entire geopolitical structure played out. Economists are welcoming it. I am very positive about it. And I never understood of why we need to change our currency into some other currency and then transfer it. It's a very simple deal. It's a vanilla deal. Let's keep it a vanilla deal is what the thought process was. And it's helped us. If you see, India is one of the least belted currencies across the world, and the dollar index speaks for itself. If we put 10 economies out there, 10 currencies out there, you will see that rupee is the least melted. Has this somehow changed the way we would want to deal with energy in future? Or has it somehow changed the India energy security overall? And we being the fastest growing economy in the world, we're saying we will do it our way, and because we want to meet that 2-digit growth year on year. And the world is also saying, okay, because you will have to grow at 2 digits, otherwise the world is going for a toss, because we're dependent on you for vaccines, we're dependent on you for API drugs, we're dependent on you for everything, for technology and other things. So has this redefined the sector, and has this redefined other sectors that are dependent on energy?
So I don't know if you guys have looked at the long-term projections for India in terms of energy security and how energy trade is going to change, especially because of green hydrogen. So there is this agency called IRENA, which looks at all these things, and maybe I can share the report as well. The projection is that the net demand for India in terms of imports in next 15 years can be zero. The trajectory we are on. So, and that's why you see the government giving so much push to green hydrogen now, because they see both it as an opportunity in terms of how they can make money, but at the same time, nothing else, geopolitical risk and energy security, they see it this way as a golden opportunity. Goes without saying that most likely it is true, but there are like maybe 30 ifs in front of it if this needs to happen. And therefore it's like a toss up whether it happens or not happens. But that's the reality of it, that it will be the case. Just as an aside, and again, because she's an Indian, the IMF, I think MD now, managing director now, Peter Gopinath, has written extensively on dollar invoicing and dollar trade. Why everything happens in dollar currency terms.
Dollars.
Yeah. And again, she has written like 3-4 blogs on IMF website. So you, anyone who is interested in these things, you can read about it. And it's very, very fascinating, because I have like done my fair share of macro research in life, and therefore I can tell you that this is true. That there is a hegemony of dollar, and it works from multiple angles. One is the financing angle, which many people talk about, that people only want to lend you in dollars because they don't want to take the currency risk. But the other place where it happens is trading. People only give you commodity or goods if you pay them dollars. Otherwise, they say that I will put a markup of 20% or 30%. And then you say, okay, it's better to convert the currency. She has extensively written about it. And again, this flow of like capital or the exchange rates, I would say it's completely driven by